All right, let's jump right in. Today, we're talking about a company that's been absolutely on fire in the market, HBL Engineering. Its stock has been making some serious waves, and we're going to break down what exactly is going on.
So let's just start with the number that's got everyone talking. A single-day jump of over 14% as of August 11th, 2025. I mean, come on, a stock doesn't just do that out of nowhere, right? A move that big is a huge signal, and it makes you stop and ask some pretty big questions.
And that really tees up the big dilemma, doesn't it? Are we looking at a rocket ship that you need to get on right now, a true once-in-a-lifetime opportunity? Or is this a classic overinflated bubble that's just waiting to pop? That's the core question we're going to explore.
Okay, so to really understand what's happening, we've got to look under the hood. Forget the stock ticker for a second. What does this company actually do? What's the real engine driving all this momentum?
Well, HBL is a serious high-tech industrial powerhouse. They're not just a one-trick pony. We're talking everything from specialized batteries to super important railway safety systems, like the Gavach system you might have heard about. On top of that, they're in high-tech defense electronics, and they're building components for the e-mobility boom. So, you see, this isn't just some random company. They are deeply woven into the country's critical infrastructure and defense.
And get this, it's not just a local story. HBL is the world's second largest manufacturer of these specialized nickel-cadmium batteries. Think about that. That credential alone puts them on the global stage in a big way. This is a company with some serious industrial clout. All right, now let's get to the bull case. The reason this stock is soaring is pretty simple, actually. The company's performance has been, to put it mildly, just astonishing. This is a story of absolutely incredible growth. Just look at this explosion in their net profit. It tells you pretty much everything you need to know. Back in fiscal year 2021, they made 14 crore. Fast forward just a few years to 2024, and that number has leaped to 281 crore. That's not just growth. That's the kind of near exponential curve that gets everyone's attention. And if you're thinking, well, maybe they just had one really lucky year, think again. This isn't a fluke. The company's profit has grown at a compound annual rate of nearly 65% over the last 5 years. That means, on average, it's grown that much every single year. That's a sign of a powerful, sustained trend. But here's what's maybe most impressive. This incredible growth isn't being funded by a mountain of risky debt. It's built on a rock-solid financial foundation. The company is virtually debt-free, which is so rare these days. It's also highly efficient with its money and pulls in really healthy profit margins. This is a well-oiled, powerful machine. Okay, so the company's a superstar. Case closed. We should all just buy the stock, right? Well, not so fast. This is where the narrative takes a sharp turn, because a great company and a great stock can be two very different things. We have to ask the really hard question. What's the real price of all this success? To figure that out, we use a tool called the PE ratio. The easiest way to think about it is like a price tag. It just tells you how many dollars you have to pay for the stock for every $1 the company actually makes in profit. A high PE just means investors are baking in some really high expectations for future growth. So let's put HBL's price tag into perspective. It's trading at a PE of around 68. The median for its industry peers, about 35. Whoa. That means investors are willing to pay almost double for $1 of HBL's earnings compared to its competitors. The stock is, without a doubt, trading at a significant premium. And here's where we hit the core conflict, the major disconnect. The market price, what you'd pay today, is around 683 rupees. But the estimated intrinsic value, that's a calculation of what the company is fundamentally worth based on its assets and earnings, is way down at around 276 rupees. That is a massive gap. And if you want to put one single powerful number on that gap, here it is. The stock is trading at a price that is 147% higher than its estimated fundamental value. This number makes the risk tangible. By conventional metrics, this stock is extremely expensive. So, where does all this leave us? We have these two powerful but totally conflicting stories. And that brings us to the verdict. This is the classic investor's dilemma, a fight between incredible growth on one side and a sky-high valuation on the other.
So how do you even begin to think about this? Here's a simple framework. Step 1, you absolutely have to acknowledge the growth story. It's real, it's impressive, and you can't ignore it. Step 2, you also have to acknowledge the price. It's extremely high, and with that comes risk. The final step is the hardest part. You have to weigh that massive future potential against the very, very steep price you have to pay today.
This slide really puts the whole argument right next to each other. The bull case, why you'd buy, is so compelling. Phenomenal profit growth, a fortress-like balance sheet, and leadership in critical sectors. But the bear case, why you'd pause, is just as stark. An extreme valuation, trading way above its intrinsic value. And that means there's almost no margin of safety, which is that buffer investors need in case things don't go perfectly. I think this quote just nails it. The market is a tug of war between a great company and an expensive stock. And with HBL right now, both sides are pulling with everything they've got. The tension is immense. So we arrive at our conclusion. And look, the goal of this explainer isn't to give you a simple buy or sell recommendation. It's to arm you with the right framework, the right data, so you can make your own informed decision. And that all leads to one final question.
So here's the question I want to leave you with. For a company that has proven it can grow like this, that's a leader in sectors vital to the country's future, and has a rock-solid financial foundation, at what point is the price just too high? Answering that question for yourself reveals as much about your own investment philosophy